Taxes are mandatory contributions levied on individuals or corporations by a government entity, whether local, regional, or national. Tax revenues finance government activities, including public works and services such as roads and schools, or programs such as Social Security and Medicare. Hello and welcome to our channel. Today we are going to discuss how to understand taxes. To help fund public works and services, and to build and maintain the infrastructure used in a country, a government usually taxes its individual and corporate residents. The tax collected is used for the betterment of the economy and all who are living in it. In the United States and many other countries in the world, income taxes are applied to some form of money received by a taxpayer. The money could be income earned from salary, capital gains from investment appreciation, dividends or interest received as additional income, payments made for goods and services, and so on. Tax revenues are used for public services and the operation of the government, as well as for Social Security and Medicare. A tax requires a percentage of the taxpayer's earnings or money to be taken and remitted to the government. The deliberate failure to pay one's full tax liabilities, which is known as tax evasion, is punishable by law. On the other hand, tax avoidance, which are actions taken to lessen your tax liability and maximize after-tax income, is perfectly legal. This is generally accomplished by claiming as many deductions and credits as are allowable. It may also be achieved by prioritizing investments that have tax advantages, such as buying tax-free municipal bonds. Taxpayers can take advantage of tax avoidance through various credits, deductions, exclusions, and loopholes, such as claiming the child tax credit, investing in a retirement account and maxing out your annual contributions, taking the mortgage tax deduction, and putting money into a health savings account. Most governments use an agency or department to collect taxes. In the United States, this function is performed federally by the Internal Revenue Service or IRS. Types of taxes. There are several very common types of taxes. One is income tax. A percentage of generated income that is relinquished to the state or federal government. The term, income tax, refers to a type of tax governments impose on income businesses and individuals within their jurisdiction generate. By law, taxpayers must file an income tax return annually to determine their tax obligations. Income taxes are a source of revenue for governments. They are used to fund public services, pay government obligations, and provide goods for citizens. Payroll tax. A percentage withheld from an employee's pay by an employer, who pays it to the government on the employee's behalf to fund Medicare and Social Security programs. A payroll tax includes the taxes employees and employers pay on wages, tips, and salaries. For employees, taxes are withheld from their paychecks and paid to the government by the employer. These taxes include federal, state, and local income taxes, and the employee's share of Social Security and Medicare taxes. Taxes that employers must pay include their share of FICA as well as federal and state unemployment taxes. Corporate tax. A percentage of corporate profits taken as tax by the government to fund federal programs. A corporate tax is a tax on the profits of a corporation. The taxes are paid on a company's taxable income, which includes revenue minus cost of goods sold, general and administrative expenses, selling and marketing, research and development, depreciation, and other operating costs. Corporate tax rates vary widely by country, with some countries considered to be tax havens due to their low rates. Corporate taxes can be lowered by various deductions, government subsidies, tax loopholes, and the effective corporate tax rate. The rate a corporation actually pays is usually lower than the statutory rate, the stated rate before any deductions. Sales tax. Taxes levied on certain goods and services, varies by jurisdiction. A sales tax is a consumption tax imposed by the government on the sale of goods and services. A conventional sales tax is levied at the point of sale, collected by the retailer, and passed on to the government. A business may be liable for sales taxes in a given jurisdiction if it has a presence there, which can be a brick-and-mortar location, an employee, or an affiliate, depending on the laws in that jurisdiction. Property tax. Based on the value of land and property assets. Property tax is a tax paid on property owned by an individual or other legal entity, such as a corporation. Most commonly, property tax is a real estate ad valorem tax, which can be considered a regressive tax. It is calculated by a local government where the property is located and paid by the owner of the property. The tax is usually based on the value of the owned property, including land. However, many jurisdictions also tax tangible personal property, such as cars and boats. The local governing body will use the assessed taxes to fund water and sewer improvements, and provide law enforcement, fire protection, education, road and highway construction, libraries, and other services that benefit the community. Tariff. Taxes on imported goods, imposed with the aim of strengthening domestic businesses. Most countries are limited by their natural resources and ability to produce certain goods and services. They trade with other countries to get what their population needs and demands. However, trade isn't always conducted in an amenable manner between trading partners. Policies, geopolitics, competition, and many other factors can make trading partners unhappy. One of the ways governments deal with trading partners they disagree with is through tariffs. A tariff is a tax imposed by one country on the goods and services imported from another country to influence it, raise revenues, or protect competitive advantages. And lastly, estate tax. Rate applied to the fair market value of property in a person's estate at the time of death. The total estate must exceed thresholds set by state and federal governments. The estate tax is a federal tax levied on the transfer of the estate of a person who dies. An estate tax applies when the value exceeds an exclusion limit set by law. Only the amount that exceeds that minimum threshold is subject to tax. They include items such as final utility bills for the month in which you die, credit card balances owed at your death, and any other financial obligations you have incurred but which are still unpaid at your death. They also include any income taxes due for income you earned in the year of your death. Tax systems vary widely among nations, and it is important for individuals and corporations to carefully study local tax laws before earning income or doing business there. There are many types of taxes that are applied in various ways. Understanding what triggers a tax situation can enable taxpayers to manage their finances to minimize the impact of taxes. Helping people provide a solid foundation for a more secure financial future. One video at a time. We appreciate you tuning in and hope to see you again soon. Hope you enjoyed this video. Feel free to click on one of our other videos. Do not forget to subscribe to our channel and do hit the bell icon on your way out. See you all next time on Top 5 Hive.